In September 2008, the global financial system stopped working. To understand how the collapse of a single investment bank nearly triggered a second Great Depression, we have to look at the invisible wiring of the economy. 6 months earlier, in March, the U.S. government set a clear precedent. When the investment bank Bear Stearns teetered on the edge of bankruptcy, the Federal Reserve stepped in to broker a $30 billion rescue. That intervention sent a loud signal to the rest of Wall Street. The assumption became that massive financial institutions were too big to fail. If a major player stumbled, the government would act as the ultimate safety net. Operating under that assumption, bankers continued trading billions of dollars in highly risky subprime mortgages. They believed their downside was protected. So when the government suddenly changed the rules of the market, the system was completely unprepared for the shock. By late summer, the crisis reached Lehman Brothers, the nation's fourth largest investment bank. As the real estate bubble burst, Lehman found itself choking on billions of dollars in toxic mortgage assets, and its cash reserves were draining fast. But Treasury Secretary Hank Paulson decided the bailouts had to stop. A former Wall Street executive himself, Paulson wanted to enforce free market discipline. His decision was driven by a concept called moral hazard. This is the risk that if you repeatedly rescue people from the consequences of their own reckless behavior, you only encourage them to take even bigger risks in the future. On a Friday evening in mid-September, Paulson summoned the CEOs of Wall Street's largest banks to a closed-door meeting. He delivered a blunt ultimatum. Lehman Brothers was failing, and the government was not going to write a check to save it. They were on their own. By trying to teach Wall Street a lesson in personal responsibility, the Treasury abruptly removed the safety net everyone had been relying on. In a financial system that runs almost entirely on confidence, stripping away that certainty created an immediate, terrifying vacuum. When the markets opened on Monday, September 15th, panic set in. If a giant like Lehman Brothers could be allowed to go bankrupt and its stock dropped to zero, investors realized no bank was actually safe. The first thing to break was interbank lending. Every night, banks loan each other cash to balance their books. But with Lehman dead, trust vanished. Fearing peers held worthless debt, banks simply stopped lending to each other entirely. That freeze immediately bled into the real economy through something called the commercial paper market. Commercial paper is a system of short-term, unsecured loans that giant corporations use to fund their day-to-day operations. Without those short-term loans flowing, major manufacturing companies suddenly couldn't finance their supply chains or make their daily payrolls. The sudden halt proved that Wall Street and Main Street operate on the exact same plumbing. Severing one major financial node at the top instantly choked off the cash supply required to keep everyday American businesses running. Meanwhile, the broader stock market was in free fall, reacting to the government's unpredictable behavior. Policymakers in Washington had sent completely contradictory messages. In the spring, they demonstrated they would spend billions to save Bear Stearns. In the fall, they let Lehman collapse without a dime. This inconsistency poured fuel on the fire. Markets can price in bad news, but they cannot function when they can't predict the rules. Investors panicked because the calculation of risk had become impossible. Inside Washington, the officials who engineered this policy experiment realized it was spiraling out of control. Federal Reserve Chairman Ben Bernanke, a scholar of the Great Depression, watched the exact credit freeze scenario he studied for decades play out in real time. Toxic mortgages provided the fuel, but the government's inconsistent signaling provided the spark. When the basic rules of the market are rewritten without warning, investors stop calculating risk and start hoarding cash. Just as officials tried to manage the Lehman fallout, a hidden trapdoor opened. The world's largest insurance company, AIG, was suddenly on the verge of collapse. This chart shows the terrifying scale of the problem. AIG had been selling complex financial contracts called credit default swaps. A credit default swap is essentially an insurance policy that pays out if a company, like Lehman Brothers, defaults on its bets. When Lehman actually did go bankrupt, those insurance policies triggered all at once. AIG was instantly on the hook to pay out billions of dollars in cash that it simply did not have. The stakes here were far higher than with Lehman. AIG had written these policies for almost every major financial institution on Earth. If AIG defaulted, the losses would cascade globally, pulling down healthy banks alongside the sick ones. Lehman's failure exposed a vast, unregulated web of derivative contracts. It revealed that the survival of the global financial apparatus was secretly tied to the balance sheet of a single insurance firm. Staring down the threat of a global economic collapse, Paulson and Bernanke abandoned their stand on moral hazard. They authorized an immediate, massive rescue package for AIG. But case-by-case rescues were no longer enough. The Treasury Secretary traveled to Capitol Hill to ask Congress for a $700 billion blank check, a program known as TARP, to forcefully inject cash into the frozen credit markets. In a dramatic reversal of his free market principles, Paulson summoned the heads of the major banks once again. This time, he forced them to accept billions of dollars in government capital, whether they wanted it or not, to artificially manufacture the confidence the market had lost. The 2008 panic demonstrated how the modern economy functions. It operates like a hypersensitive nervous system, reacting instantly to the health of its connected parts. The 2008 panic revealed the fragility of a global economy held together by collective confidence. Once that trust disappears, the machinery of international trade effectively stops working.